Okay, trading securities can involve high risk and the loss of any potential funds invested. Investment information is provided by our user group may not be appropriate for all investors and is provided without respect to individual investor or financial sophistication, situation, time horizon, or risk tolerance. Therefore, any of the information, techniques, and or securities that we talk about by our user group is intended to be for education purposes only. Is not intended to be a recommendation to buy or sell any specific security, no matter what your rat brain would want you to do. So having gotten that out of the way, why don't we just kind of talk about tonight? What are we going to do? Well, we're going to spend the next hour or so covering option basics part one. And then part two tomorrow, we're going to pick it up with the basics around options pricing and Greeks and some very simple strategies for the new options trader. So that's kind of where we're going to be focusing here. And then also I'm going to use my platform, Thinkorswim, and I'll show you common things you want to see on your platform and how things are laid out and so forth and so forth. So why don't we just get everything rocking here. Let's get everything started up. Now, what are we going to talk about tonight in part one? Well, I just want to talk a little bit about some of the option basics and the lingo. Options is one of those areas where there's just a lot of lingo or terminology that's used in the options market. And it's really good that you understand that. Now, you can Google and you can find options definitions and terms, and there's probably hundreds of them, but I'm just picking out some of the most basic ones here that I think you need to know before you start pulling the trigger on buying calls or buying puts, which tends to be one of the first things you do unless you've got stock, and then you tend to start selling them. And we'll talk about that, selling calls against the stock. We'll talk about that later. So that's kind of how that's going to work out. So now, why don't we just jump in here and let's just see how this thing goes here. So option basics and lingo, that's going to be the first thing we're going to talk about. Then we're going to talk about the attributes of calls and puts. Okay, we're going to discuss those. And again, we're going to stay with the basics of what comprises those. Then we're going to spend some time on profit and loss diagrams. You know, for the I would say the basic and the intermediate option trader, you live and die by profit and loss diagrams. As you get into advanced, you use them, but in maybe perhaps a different way. And you get more and more focused on the Greeks and managing the Vega and Delta and possibly Gamma of your positions. For those of you that are out there, you may know what I'm talking about. For the beginners, don't worry about that right now. We're not going to focus on that, but we're going to focus in this option basics piece tonight on some basics around profit and loss diagrams. What do they mean, and how can you use them? We're going to talk about calls and puts in action. You know, what are some common trades? What are some misnomers? When people buy calls and people buy puts, what are some misnomers and what are some common mistakes that a lot of rat brain traders make? For those new folks out there, when I refer to a trader as a rat brain trader, that's not a negative. That's just everybody has that rat brain in them where they make a trade, and then after they make the trade, they're like, why the heck did I just do that? That was really crazy. So those are just the fear and greed in the marketplace working, and that's all the more reason why you need to have a plan before you go into a trade. And we'll talk about that in part two tomorrow night. So call and puts in action, and then we'll just kind of go through it. So why don't we start off with options and just a little bit about background on them. A lot of you guys don't realize that options, I started trading options in the 80s, but they actually were developed. Calls were developed in 73. And then the interesting thing was put options were developed in 77. So for over 4 years, there was no such thing as puts. There were just calls, and they were used to hedge risk, whether you were buying them or selling them. And market makers and market participants got very good at just using calls. And in tomorrow, we'll go into some of the basics on what's called option synthetics. And what that means is you can use two different securities and you add them together and they equal a third security. So I'll show you how that works tomorrow night. But just suffice to say that calls were developed first and then puts were developed in 77. And then the purpose of the original design of options had nothing to do with making money. All it had to do with was hedging risk. That's the only reason why options were developed. We need to hedge off risk. So they were designed primarily for commodities players, futures players, farmers, big production companies that needed to hedge off risk exposure in the market if they were long or short various products. So that was the primary reason why options were developed. Now, over time, we've gotten fairly sophisticated. After put options came out in '77, and then we've gotten pretty sophisticated in the development of how options are priced, and we'll talk about that in a minute. Then options became a tool for more of the what I would classify as the mainstream audience. When options first came out, they were mostly used by professionals. In fact, if you remember, for those of you that are on the session tonight, if you remember the computer world and technology, you didn't have technology back then like you've got today. You had most people, and I remember doing this too, you would plot prices on a graph. You would buy the graph paper and you'd plot prices every day, stock prices, so you could get a gleam for where things were moving up and where they were moving down and things like that. When technology came to bear, and it basically came down to the desktop in the form of desktop PCs, it went from the mainframe to the mini, the AS400s and so forth, down to the PC, and then PCs became smart PCs. Then, if you'll notice, all of the technical indicators that traders use today, those are indicators that traders use on their charts to help them determine a trade direction and a trend. Most of them were developed in the 80s. Why were they developed in the 80s? That's when the computer came out. The PCs came out and allowed people like Wilder and some of these others to develop the MACD and the RSI and all of these other indicators. They allowed, the PC allowed that kind of work. Once they did that, it brought to the common retail trader, which would be folks like you and I, the ability to be able to trade options a lot easier. But even in the 80s, it was still a very illiquid marketplace. But it did allow you to now, instead of just trading stocks, where I'm just going to trade it in two directions, either up or down. This typical stock trader only plays the market up or down. That's it. In fact, about 90% of the stock traders out there only trade it up. They don't trade it down. So most of the people that do short stocks, or the more of the trader type, a little bit more sophisticated folks. So most people are just used to then trading in the up position, meaning their trend is generally up. That's generally how they want to do it. Now, what options have done has allowed the individual trader the ability to be a lot more versatile. Not only versatile into a direction, but you can be direction indifferent or direction neutral. Now, some people may not know that, but there is a difference between a neutral direction trade and a indifferent direction trade. So, for example, just to kind of highlight this so that you guys know what I'm talking about, and I haven't lost my mind, for the basic folks out there, if you've got a stock that is, let's say you've got a resistance line and a support line. So this is our S1, this is our level of support, and this is our R1, which is our level of resistance right here like this. You could have a stock that, came up, hit this, came down, did a retest, and then is coming back down, and it does one of these numbers. It comes down, it hits, comes back up, it does a retest, and then it starts working its way back up, and it's going back up to that direction again. So you can say, okay, I've got at least two tests of a major price level, all right, and sellers won here, pushing the price in that direction. But I also have a test down here of a major level, and buyers won, pushing the price in this direction. So you know what? I'm going to be price neutral. Meaning, as long as the price stays between this area right here and it stays somewhere in this sandbox, then I'm going to put on a trade and I'm going to make money. So options allow you to do that. Now, trade indifferent is a little bit different than that. Trade indifferent basically says, okay, you know, the stock is going like this, and let's say, well, let me redo that just one second. Let's say the stock is doing one of these kind of things. Let's say you have a pattern that looks like this, all right? And you know, the stock is kind of going like this, like that, and it's coming like that. So the price, you could draw a downsloping trend line and an upsloping trend line on a graph or a chart, and you've got a symmetrical triangle. And typically in a symmetrical triangle, and let's say this is a daily chart, and the distance from this point right here to right here is 4 months. All right, so it's been in that pattern for quite some time. All right. Typically, the rule of thumb is the longer that a stock stays in a particular pattern, when it breaks out, the greater the move will be. Well, a direction indifferent move says, you know what? I don't really care, quite frankly, whether this stock makes a run in that direction or it makes a run in this direction. I don't really care. So I'm direction indifferent. But I'll tell you what I do care about. When it makes its run, whether it runs this way or it runs this way, I want that sucker to really run. I want it to run a good deal. So that's direction indifferent. You want it to run, you just don't care which direction. So options allow you to trade that kind of scenario. Now, as you get more into the intermediate and advanced levels, then options allow you to trade other things as well. You can trade volatility, you can trade interest rates. There's a number of different things that you can trade. But for the beginner, and I would recommend the intermediate trader, these are the primary styles you're going to trade. Now, you may say I'm bullish, but I'm only mildly bullish. That's okay. There's a number of strategies you can pull off the strategy shelf that will play a mildly bullish, a little bit different than it would play a moderately or a strong aggressive bullish. Same thing with bearish, mildly bearish or very aggressive bearish. Neutral, it is what it is. It's going to stay within a range. And there's also in direction indifferent, you know, there's different ways to play in direction indifferent and different strategies that you can use for that as well. So basically, options, I guess what I wanted to highlight here is options give you all of that flavor. Now, just as a recommendation for people getting into options, and trust me, I've been there and I've done this, the tendency is to go large too soon, too early, and you need to practice. And what I recommend, especially for the folks that I coach, I recommend that, you know, you have a bullish strategy, you have a bearish strategy, you have a neutral strategy, and you have a direction indifferent strategy. And then I would say have 2 strategies for each one of these. If you do 2 strategies for each one of these, then you'll be fine, okay? 2 strategies for each one of these. So that gives you basically 8 strategies that you want to master. If you master these 8 strategies, you will find that from these strategies here, I can't spell tonight, you know, well, you guys get the idea. If you master these 8 strategies, then you will be outstanding, assuming you understand how to read a chart and develop your bias. If you read a chart and develop your bias, then you'll be very good at how you put these things on and how you run them. So basically, this is how you want to play this game right here. And as a beginner, remember, if you say, okay, I am bullish on this stock, or this underlying security, let me go to my strategy shelf. Here are 2 bullish strategies I can use. I'm going to use bullish strategy number 1. And this way, because folks, as you get into option, the tendency is to get too fancy too soon, and there's probably 30 or 40 different strategies and nuances off those strategies. And I find that where most beginner and especially intermediate, you can get very, very confused very quickly and get in over your head with a very sophisticated strategy, end up getting hurt, and only until you close it down do you know why. I do recommend that you paper trade a lot so that you can understand how this thing is going here. So that's kind of how this thing would play this thing out. So now let's come in here and let's take a look at some of the option lingo. Everybody, one option contract is worth 100 shares of stock, equity, stock. One option contract is worth exactly one futures contract. So they're kind of even for even here. Leaps. You may have heard the term leaps, long-term anticipation securities. Generally, these are options that expire 1 year from today or greater. So the longer they go out, then they're typically leaps. So leaps, as we'll talk about later, are really a wonderful, what I call a stock replacement strategy. Leaps are pretty good because they allow you to say, I'm going to buy a stock, but I can't afford Priceline, or I can't afford Apple or some of these others. They're just too expensive for me. So I'm gonna try something that is a little bit easier to trade, and something that I can play with and work on. So that's kind of how this thing works here. So that's leaps. Now, if we look at the other ones here, strike price. Well, obviously, strike price is a very key element. And when I lay out the we'll take a look at an option chain, and I'll show you. Because, you know, with stock, it's very easy. I'm going to buy stock or I'm going to sell stock. So the price is the price is the price. With options, there's tons of options, no pun intended, but there are a dramatic quantity of prices that you can choose to buy. So all of them center around the strike price. And the strike price essentially is the price at which an underlying stock can be purchased or sold based on that option contract. And the expiration date, or you may hear the term often, expiry, is the date of that option contract expiration. So most options expire on Saturday following the third Friday of each month. Now, as we get into more advanced topics, and I'm not going to get into them, but there are certain options sometimes that, you know, they break out a little bit differently. But for the beginning trader, just understand that the third Friday of every month, at the close of trading on the third Friday of every month, the options expire, but then the settlement date really doesn't happen until Saturday. And as you get into individual strategies, you will learn why you either want to roll or shut down before Friday. But just understand that the expiration date is when it expires. Now, the nice thing about the technology today is that every trading platform basically tells you when that thing is going to expire. So you really don't have to worry about it. Most technology makes it a lot easier for you instead of you having to track it. Because there's options where they offer monthly expirations. There's some options that offer expirations but only 4 months or 6 months out of the year. They don't have an option series for every month. There's some securities or stocks that have options not only every month but every quarter and every week. So you just have to look, and the CBOE is constantly changing how many option contracts and expiration periods are available for a stock. Same thing with the strike price. If you've got a stock that's been trading around $10 a share for 5 years, 7 years, you know, they may not have strike prices at $15 or $20 a share, but if that stock starts moving up, well, then they got to start adding strike prices to that stock. It's the same thing like when Apple was back at $150 a share. They didn't have strike prices at $250 and $300, but then when Apple started moving many years ago, they started to, you know, they had to add all those strike prices. So you have to check and see when they're adding these things out there, but it's very, very simple, and I'll show you when we get into the Thinkorswim platform how to just lay everything out. In the money. Now, obviously, there's a couple of terms you have to understand. I'm going to just lay them all out here for you. In the money, at the money, and out of the money. And it sounds like a Vegas term, but it really isn't. It's a option contract term, and it really, the concept around it is very simple. All right. In the money means essentially if the option contract you're holding at that point in time were to just expire, and That was it. That was the expiration date. Any part of that option that has any intrinsic value, which we'll talk about in a minute, then that part is in the money. And I'm going to lay out for you what that looks like. At the money means it's very simple for at the money. At the money is simply the strike price is the same price as the current price of the underlying. That's an at the money option. And then, of course, out of the money, and again, they vary from puts or calls, and I'll show you here in a minute. Out of the money means there is no intrinsic value in an option. There's not, or in an option contract. There's no intrinsic value at all. Now, these three things here, you've got to know intimately. These are basically probably areas where you're just going to need to know by heart. And it'll take a little bit of time. And I know when I first got into options, it took a little bit of time to just kind of work around how this works. But and the abbreviations is where most people spend, these abbreviations here is what you want to know. In the money, at the money, and out of the money. So let's take a look at that and see what that means here. If I take a option chain here, and let's take a real basic option chain here, and we'll keep it really simple. So if I own, let's say the stock price right now is sitting at $105. Stock price, all right, I don't know why I can't spell tonight. The stock price equals $105, all right? So if the stock price was $105, I can say, okay, well, that's simple. If the stock price is $105, then for the calls, let me just see here, for the calls right here, okay, I want to pick an at the money call. Well, an at the money call, I just come down here to the strikes and I say, oh, this one right here. So this is an at the money call right here. All right, so it's very simple. The strike price equals the stock price, so it's at the money. So that's where we are. Now, on in the money, meaning I've got intrinsic value in this option contract. This would be an in the money right here for a call, okay? This would be an in the money. Why? Because the stock is at 105 and the strike price is at 100. Remember, and I'm going to show you on the next screen, when you have a call, you basically have a right to buy something if I'm long that call. So that means I can buy that stock at 105. So that means, I'm sorry, 100. But the stock's at 105. So I'm in the money. And this right here would be out of the money. Okay, this would be totally out of the money here. So if I were to say I want to buy a option contract, a call option contract at 110, well, the fact that I want to buy it means there is some value. So there is some nominal value to that contract, and that value is determined by a number of things, which we'll talk about in a minute. But let's just say that thing cost me $1. So if I were to pay $1 for this contract here, that entire $1 is out of the money, all right? That entire $1. So I would just put it right here. It's entirely out of the money. Now, if I were to pay, let's say, $3 right here for this one, okay, $3 right here, that means, okay, that is at the money. So in reality, if the contract were to expire today, generally speaking, I probably would lose all of my money. This one right here at $100, well, we know at a minimum it's worth $5, right? We know at a minimum it's worth $5 because I have the right to buy the stock at 100, and I could buy it at 100, turn right around and sell it in the open market for 105 and make $5. So we know it's going to be worth at least $5, but they're not going to sell it to me for just $5. They're going to sell it to me for $5 plus. So they may sell it to me for $9, all right? Or some number there that says, okay, $5 of that $9 is called intrinsic value. And the rest of it is all extrinsic value, which I'll show you here in a minute. So that's pretty much how the call side of the house works. Now the puts, as you would imagine, are just the opposite. So an at the money put here is the same. an at-the-money put is going to be the same as a call. At the money is just what it means. At the money is at the money. Now, but it's going to be just the opposite with a put. Because remember, with a call, you want the prices to go up, all right? I'm basically buying a call, so I'm going long a call option contract. So you want the prices to go up. If I am long a put over here like this, I'm long a put, I basically want prices to go down. So if I buy a 110 strike put right here, well then guess what? I'm in the money, right? Because the price is currently $5. It's already moved $5 in my direction before I even buy it. So I'm in the money right here. And let's say this is going to cost me $9, all right, because I'm in the money and I'm going to buy that thing. At the money, it may cost me about $3. In reality, the put here would cost me just a little bit less than the call would. Typical pricing in the option market, at the monies, assuming you're right at the money, calls cost just a little bit more money than puts. The reason why is the stock chart and the markets and the pricing of the option model is logarithmically driven, which means that stocks have a tendency to go up due to interest rates and inflation. Now, even though our interest rates are 0 to 0.25% right now, they're held down by the FOMC, generally there is an upward bias to the market. That means an at-the-money call is probably going to cost a little bit more than at-the-money put. So you could probably say the at-the-money put may be $2.90, maybe just a little bit less, but they'll be very, very similar. And then a 100 strike put, which is way out of the money, you know, it's probably going to be somewhere around, I don't know, maybe 85 cents or something like that. So that just shows you, you know, the puts and the calls. Now, most beginning traders, and sometimes even intermediate traders, when you're forced to think very fast, can get these things mixed up. Because remember, we talked about the long side of the equation, meaning I'm buying it. I'm buying a call. I want to be bullish. I'm buying a put. I want to be bearish. All right, but there's other things that you can do too. And let me just, before we do that, why don't I just jump into a, let's just show you my Thinkorswim page right here. And I know it's small font. It may be a little bit harder to see. I can't really blow it up too much here without messing up my screen and my audio equipment. So, but let me just show you. I've got the diamonds up here. And you can see as I put the diamonds up here, it's an ETF for the Dow. You can see right here on the screen most software, and you can see right here I've selected, just show me 25 strikes. And we're looking at the month of December, okay? You can see right here, as we look at these, you'll see a gray box here like this. And then you'll see a black box. This gray box is meant to be basically what is in the money for that particular option series. All right. So in this particular case right here, we've got these strikes for the calls. All right. If we look at the strikes for the calls right here, here are the strikes for the calls. You can see the current price, the last price for the diamonds finished up here at 131.74. Now the diamonds have a strike every 1 point, 120, 121, 122, and so forth. Not every security have dollar-wide strikes. Some securities have $5 wide strikes. Some securities can do even bigger than that. Some securities go 250. It depends on the liquidity and the volume of that particular security. Generally, if it's a very popular, very widely traded security, as the diamonds are, or the spiders, those are some of the most, especially the spiders, they are the most heavily traded options out there. ETFs out there, and options on these ETFs are traded very, very heavily. So you can see how these things really play themselves out. So you can look and say, okay, well, an at the money for a 131.74, you know, nothing really ever falls exactly at the money. Very rarely does it stay there very long. So an at the money for a 131.74 would probably be considered 132 right here for the calls. Okay, 132. Now, the other term that they call that is near the money. Near the money. So, and it's pretty close. So that's kind of considered at the money for just all practical purposes. For the put, you can see with the put, they would still use right here, they would probably use 132 as well because it's closer to 132, and I would probably use 132 as well. We're just saying, okay, this is the at the money price right now, 132. That's how I would do it. Excuse me. Now, I want to define a couple more terms, and then I'll talk about these headings up here that I've got, and then how you can change these headings up here, and what's really important and what's not. We'll talk about, you'll see up here some things that I have up here like delta and open interest and theta and volume and implied volatility and all these fun things. We'll get into these tomorrow night. But right now, really the only thing you want to just kind of keep an eye on, and let me just make it really simple for you. Let's just call it this. We've got a couple of key things I want you to focus on for now. You got a volume column, and you've got an open interest column. And then, of course, you got the bid and the ask, okay? In every option series, just like stock, you've got a bid and the ask. And it's very, very easy to understand, but you can get fairly confused with it. And you'll notice that there is a difference between the bid and the asks. Like right here at 132, we'll take a look at this one right here, 132. At the bid, it's $1, and the ask is $1.04. So what that basically means is you've got a 4-cent, 0.04 cent spread between the bid and the ask. Now, when the markets are trading, it's probably tighter than that. It's probably only 1 penny. But what this means is when you buy an option contract, you are buying at the ask. When you are, and it's called the natural, meaning this is the natural market price of this option contract at this strike price. If you're selling that option contract, you're selling at the bid or $1. So if you were to buy it at the natural or $1.04, all right, that would be the price you would pay for it plus commissions. And then you said, oops, I didn't mean to do that. Let me sell it. You would sell it at $1. And then what would happen is you would be underwater by 4 cents or $4 per contract, because option contracts are quoted in 100s. Okay, so if you look at the pricing here, we'll go through this. You'll see here that you'll see a price 1.04 or 100. So when you see a price at 1.04, you know, that's generally how people quote option prices. It's 104. But what they really mean is $104 per contract. It's nice because they use 100 as the round number, so it keeps it very simple. So you can see down here at a 144 strike for a put, because that's way in the money, you'll see that option price for the bid is $12.30, and then the ask is $12.60. So a couple of things I want you to look at here. Notice here you've got between this one and this one, you've got a 30-cent spread between the two, whereas right here you only got a 4-cent spread between the two. So this difference is due to the fact that the deeper in the money you go, because this is a put now, the wider the spread becomes. When you move further out of the money, generally the spread can be a lot tighter. In general, it's tighter. Only reason why it's like that is when a market maker is buying or selling these securities to you, they've got to hedge off that risk. And it's harder to hedge off a deeper in the money call or put than it is an out of the money call or put or an at the money. So in general, when you get deeper in the money, the bid-ask spread can get fairly wide. As you move towards out of the money, the bid-ask spread can get fairly narrow. Like here at 120 for a put, you're way out of the money here. The spread is only 1 penny, all right? It's only 1 penny here. So you can see I'm moving from 30 cents to 4 cents down to 1 penny as I move from deep in the money to deep out of the money. And again, and the only reason why is it's only because of the market makers being able to hedge this risk off. That's all it is. In fact, you're at 1 penny right here. All right, and this one using a put is a 125 strike. It's out of the money, okay? And look at the volume here. There's or the open interest is 15,000 right there. Volume was relatively low, all right, but the open interest was a lot higher. We'll talk about that in 1 second. So when I look at this chart, you know, we've talked about the bid and the ask. Now, typically in a very tight market, remember, when the market is moving, the Dow, you know, this is 131.74, but if the Dow is starting to move up, it can go 75, 77, 80, 81. So these prices are moving all the time. So generally, when I got a tight market like this, meaning there's a very narrow range between the bid and the ask, you know, they come together in such a way that it's just a very narrow margin and it's only just a few pennies. Generally, I'll buy at the market because if it's moving pretty quickly, you're going to miss the trade. All right, 1 or 2 pennies is not going to kill me. If I'm trading a large quantity and the market is fairly slow, I'll try and split the price. And then it's called a limit order, because what I'm doing now is saying, okay, I know it's bid $1 and it's ask 104, but I'm going to come in and see if I can pick it up for 102. All right. The market maker will not let you buy it at $1 and will not let you sell it at 104. Assuming this price stays like this for, let's say, 5 minutes in the market and you were to go do it, they will not do that. They wouldn't be in business very long if they did. That's how they make their money. They don't. Most market makers do not make their money on betting direction of the market. They hedge off everything that they do, one-to-one, complete hedge. All they're really in the business of is picking up pennies and nickels and dimes on these spreads. And believe me, they do this all day long, and they make pretty good money doing it. They're very good at it. So they're not going to give it to you. So in a fast-moving market, then you generally go for the natural. In a very slow-moving market, you can try to get somewhere in the middle on a highly liquid stock. Now, if we put a stock in here that's not as liquid, let's say I'll pick one out that we traded before, and our users, we traded this. This is gas. In our user group, we like to trade commodities, and a lot of people can't trade futures on commodities, and I saw an opportunity for going short gasoline, and we put on a trade, and for those that couldn't trade the futures, I recommended UGA, which is a gasoline product, gasoline ETF rather. Now let's look at December. If you look at December, let's go through the same scenario again. We'll just use puts. Let's use calls. If we come over here, right now the price is 54.84. Well, if we look at the strikes here, let's go find 55. That we'll call that at the money. Well, here's 55 right here. All right. So if we come over and look at the 55s, we'll see that it's bid 80 cents right here. So the bid is 80 cents. For the 55 strike. So we're looking at the 55 strike. I'll write this up here because I don't know if you can see the screen that well. And then the ask is $1. All right. So that means for one option contract, let's say I want to buy it, I'm willing to buy it for $1 or $100, which would be the nominal value, the real value, or I'm going to buy it, and then I would have to sell it if I wanted to sell it for $80 or 80 cents. So now you've got a 20-cent wide bid-ask spread. Now this is at the money. If we go deeper in the money here, let's go down to 45 right here. Look at this one. We've got a bid of $9, all right, and we've got an ask of $11. That's a pretty wide spread, isn't it? That's a $2 spread right there. That spread is 10 times greater than this spread right here at the money. And this is a 45. So I went 10 strikes in the money, and look at how wide this thing went. And if you look at this, $2, if you were to buy it at $11, okay, and then divide 2 by it,
if you were to take $11 and divide that out, that works out to almost 20%. All right, slightly under 20%. So that is almost a 20% hit. That means if I go deep in the money here, this thing's got to move more than 20% before I even make any money. So liquidity, which is what I'm trying to get at in this long diatribe here, is very, very important. The liquidity and the tightness of the market is very important. Now, when we traded UGA, we had certain strategies that I deployed that was in our ratio diagonal seminar that showed people how to do this and leverage this so that they weren't getting stuck with this big, wide spread. Not big ass spread. A big ass bid-ask spread. So that's how we set this thing up. And it turned out to be a really profitable number for the folks that did the ETF. But we did a ratio diagonal on this, and those that took the futures made, I think, about $15,000 a contract on this trade. But this shows you, and again, look at this right here. Here's the other thing to look at. If you look at the volume, look at that. Nothing's traded, right? Very, very low. In fact, over here, nothing traded today. Absolutely nothing. It was zero volume. So these guys are going to price these things pretty wide. And then if you go in really deep, well, forget about it. It's going to be very wide. And if you look at the open interest, which I'm going to explain here in just one second, open interest, well, let's talk about it now because I'm talking about it a little bit. Open interest with stock, it's very simple. With stock, you either buy the stock or you sell the stock. It's pretty simple. And if you buy the stock, then you own the shares. It's a fixed number that you're trading, right? So you know what the volume is. The volume is how many shares were traded that day, I bought or sold. With options, remember with options, it is not an investment. An option is a tradable vehicle. It is a trading type of vehicle that has an expiration date to it. It's got an expiration date to it. So what that means is when you create an option, because every option is created, if you say, I am going to buy an option, well, then that would be, and you don't close that option at the end of the day, open interest is 1. Now, if you happen to want to buy a call and someone else wanted to sell that exact same call, open interest for the day would be 0. No new option contracts were created. So open interest is how many new option contracts have been created for that strike level, at that strike level. How many open interest, it's like futures, how many people are holding these option contracts that have not shut down? So if we just create options right now for UGA and there's an open interest of 1, and that open interest happens to be 155 strike, 155 strike call, all right? 155 strike call, long call. And I say I want to sell I want to buy a 55 strike call. And this fella here that owns the 55 strike call says, I'll sell you mine. And then when that transaction happens, no new open interest contracts are created. However, if you come in and say, I don't want to buy the 55 strike, I want to buy the 56 strike. So if you buy the 56 strike, then what happens is now there is one open with this guy here, and let's say he doesn't sell it. You buy one at 56, so you buy one. So now the total open interest is 2. I know for beginning traders it can be a little bit confusing about open interest, but that is how open interest works. Volume is very simple. How many trades were done in the day? That's all it is. How many option contracts were traded? So in the case where one wants to buy and one wants to sell, that was one contract volume that was traded that day. So the volume is fairly simple. Open interest, though, does give you an idea of who's holding positions and where the key strikes are. So from a basic perspective, that's how that works. Now, if we come back into our chart here, well, we don't want to go there, do we? Let's come back. Let me just, let's go from current slide. All right, so we took a look at these right here, and well, let's see, we were right here. So if we come back over and let's just finish up some of our lingo, and then we'll go into option price in a little bit, and then we'll go back to the chart again, or to the option chain. Exercise is another very important term, and you may have heard that before. An option owner, which is a holder of an option, can invite their right to buy or sell that option. That means they are said to exercise their rights to that option contract. And note that a call option holder exercises their right to buy, and a put option holder exercises their right to sell. And I'll lay that out for you on the next screen. I'll make it a little bit clearer for you. Assignment is just the opposite. When an option holder, meaning the person that has the long position, exercises their rights, well, the option writer, the person who wrote that short position, is then assigned. So you're going to get very comfortable with these terms, exercise and assignment. Then, of course, you may have heard the term American style options. These options can be exercised anytime, meaning even though we still have 2 weeks left until the expiration date, I want to invoke my right to, if it's a call, buy that stock at my strike price. I want to do that right now. Or if it's a put, I want to invoke my right to sell that stock at my strike price. That's an American style option. American style options are generally priced a little bit more expensive because they come with a little bit more risk to them because of that right of exercise. Now, European style options, most cash index options like the SPX or the Russell, they're European style options. And for those options, they can only be exercised upon contract expiration. So if the contract expires, that is when that exercise right happens. And there are certain strategies that make European style options better than American style options, particularly if that option strategy is leveraging short positions. And you don't need to worry about it right now. We're going to talk about it a little bit more when we get into the strategies part. But those are just some things you need to understand. Parity is very simple. That's just when an option is, you'll hear that option's trading at parity. That means basically there is no extrinsic value in that option. All of it has expired and it's ready to go, and you have, it's essentially trading at parity. All right. So if you've got a 55 strike call, let's say, and the stock's at 56, and the value of that option is $1. Typically it'll be 105, 104, or it'll be 110, 105, 104, and finally it comes down to exactly equal to the stock price. That's considered trading at parity. There's some interesting things that happen around stocks and parity and dividend payments. We're not going to go into options basic tonight or tomorrow, but just understand when you've got dividends paying out, and we'll talk about that tomorrow night on just some of the basics about how dividends affect both calls and puts when a stock declares a dividend, or a company declares a dividend, and what does it do to the stock price. And then open interest, as I said, stocks basically have a fixed number of shares that are traded, but options involve the creation of an actual contract. So open interest, essentially, in really net terms, it tells you how many open contracts have been created. Very, very simple. Now, the participants in an options market, I think you've heard me use the terms before, the buyers of calls or call option holder, the sellers of calls or call option writers, and then the buyers of puts or option holders, sellers of put or option writers. Now, you may also hear the term, especially if you're talking with your broker. Really, there's only two things you can do. You can buy something, or you can sell something, right? That's really the only thing you can do. You can't barter it. All right, so you can buy something or you can sell something. So if you are a buyer of calls and you're going to open a position, every time you open a position, you do something called buy to open. All right. So when you talk to your broker, for those of you that do it that way, this was the old-fashioned way. You say, I'm going to buy to open that position, or you'll hear the term BTO. I'm going to buy to open that position. Now, when you close that position, what do you think you do? Well, you sell to close it. It's very simple because you got to do the counter transaction to that to close it. So you sell to close. And that makes a lot of sense, right? You buy it to open it, and then you sell to close it. So these here, are basically very, very simple. I'm going to buy to open. I'm going to sell to close that position. In this case right here, when I buy to open, I'm an option holder. All right. When I sell to close it, I'm closing it out. Now, let's go down to the next one. Here, a seller of calls, remember, you can sell something as an opening transaction. And this confuses a lot of beginners. But you can sell something to open it. So when you sell something to open, right here, I'm selling to open a position. So it's very basic. I'm selling to open a position. I am a call writer in this case. And the most common case for an option beginner is I have 100 shares of stock and I want to do a covered call, so I'm going to sell to open one call contract. All right. Now, just like we did with buy to open, sell to close, well, in this case, we're going to buy it to close it. We're not going to sell it. All right, we're going to buy it to close. So this case right here, we buy to close. Now, when I first started getting into these, the trading platforms, and I think some of you may be aware of this, but I see a lot of junior folks out there too who may not have been doing this in the 90s. Let me tell you, it was pretty confusing because the platforms were very unforgiving. I can't tell you how many times I would sell something to open it, and then I would sell it just in my mind, my rat brain. I'm going, okay, I want to close the position, so let me sell it. But what you're really doing is if you sell to open 10 contracts, and you go, well, let me just close them, and I'm going to sell them. So you sell 10 more, and you think you closed it, but you just doubled down your position to 20 contracts. So just remember, in any opening position, all right, you can buy it to open it, or you can sell it to open it. And then whatever you do to open that position, you do the opposite to close it, all right? So if I buy here, I'm selling to close it. If I sell here, I'm buying to close it, all right? It's a very easy concept, but, for whatever reason, when we had older time platforms where, TOS today, and some of the TOS is probably one of the most sophisticated options platforms out there. If not the most sophisticated trading platform for options. There's no way we had something like this. So you could really mess up with these things. So this is how this thing works like this. So buy to open, sell to close, buy to close. So when you sell anything, right, when you sell anything, you are an option writer. Doesn't matter whether it's calls or puts. When you're sellers, you're an option writer. Very, very simple to understand, very simple concept. When you are a buyer, you are an option holder. Whether it's calls or puts, it does not matter. If I'm a buyer, I'm a holder. Very simple. So you may have heard the term buy right. Buy right is basically a covered call term. I'm going to buy stock and then I'm going to write a call against it. It's done as one transaction. So that's kind of the participants and the basic transactions you can do in the option marketplace. Now, I just went through this, so I don't need to do it again. I thought the other screen would be a little bit easier to explain it. Let's look at an ROI example. One of the reasons why most rat brain traders that get into options are really drawn to it, and this is where they get into a lot of trouble. It is just one basic concept, and that concept is called leverage. All right? You are really leveraging everything really to a pretty greater degree. And by the way, there are option contracts on futures. And for those of you that don't trade the futures market, the futures are leveraged on an underlying market like oil or something else. And an option contract is leveraged on leverage. So it's even more highly leveraged. But for now, we're looking at equities. So let's say a company is at $50 a share. Well, if you buy 100 shares of stock, it's going to cost you $5,000. Your risk in that trade is $5,000. Well, now, that's the textbook risk. The reality says, you know, unless you bought a tip from Uncle Louie and you spend $5,000 on a 10-cent stock or a 25-cent stock, and, you know, it's like going to the horse races, yeah, then your risk is like that. But if you buy most stocks today, they're fairly liquid, and especially in the S&P 500, clearly the Dow, but the S&P 500, generally your risk is it's not going to go to zero. But in theory, it can go to zero. So technically, textbook, your risk is all $5,000. If you use an option, and let's say you buy one call option at $4, well, that equates to $400, okay? So your risk is only $400 because you are long that contract. That's the most you can risk. If the stock increases in value by $2, well, you make a $2 profit in your stock, or you got a 4% ROI. So you've tied up $5,000, you make a 4% ROI. Well, not going into details, but let's assume it goes up by $2. Your option contract goes up to $4.50. Well, if that's the case, you make 12.5% ROI. So you make 12.5 right here. So in one situation, you make 4% over here, and over here you make 12.5%, and you're only risking $400 to do it. So that concept of leverage is what makes options very exciting. But it's also what really screws with a lot of rat brain traders' heads. And you've got to be very careful about how you do that. So, but that is the leverage that really drives people into the options trading world. Now, let's talk about these things, because you've heard me talk about long and short and calls and puts. So let's look at this a little bit more detailed here. When you buy a long call, you got rights, all right? That means you don't have to do it, but you've got the right to buy. Your expectation is you're bullish. It's a debit trade. That means you got to pay to play, and you buy to open. So if you've got a stock sitting at $100, right, like this, and you like the stock, and I go, you know what, I want to buy to open one contract, so I'm going to buy to open one option contract, one call, like that, and forgetting about everything else, the strike price and everything else. Let's just say, boom, that's my right. And let's say the strike price is 105. We'll keep it simple. That would be a strike price. K is an abbreviation for strike. So I'm buying it at 105. So that means I have the right to buy this stock if it goes up to $105 a share. And for that right, I'm going to be able to buy 100 shares for every one contract that I buy. And let's say that thing costs me 50 cents. So that means you multiply it by 100 for the math, and that contract's going to cost you $50 plus whatever trade commission you have on that per contract. Okay, so if you buy one contract, so you're basically saying, and let's say for now, we're going to go out 3 months. All right, so let's say I've got 3 months for this stock to go from 100 to 105 to break even, right? And then it needs to go up a little bit more than 105 to recover my $50 right here. So that's what you're buying the right to do. So your expectation is bullish. You got to pay to play. Now, let's look at the other one, a long put. If you look at a long put, well, again, you've got a right. Remember, you're long and you're long. So you've got rights in this case. So with a long put, you have a right, but in this case, it's to sell. It's not to buy. Because the name put kind of came from the old acronym, we're going to put it to you. So if I buy a long put, I'm going to put this stock to you at the strike price that I do. So again, with the same example, if the stock's at 100, okay, that's the stock price. You know, it's at $100 a share. So it's $100 a share right here. And let's say I do a strike price of, I don't know, let's say 95. All right, so now I'm buying a put. That means I have the right to sell this stock to anybody I want, and I don't even choose who. I have the right to sell that at 95 a share. Okay, well, right now the stock's at 100. So ideally, with a long put, I want it to go down, right? If it goes down below 95, that's good. It can go down to 90, to 80. Let's say it goes down to 80. That means when that stock's at $80 a share, I have the right to sell that stock at 95 a share. That's a long put because I have the right to sell it at whatever strike price I pick. So that is how that works. Now, if we come over here and look at a short call, now we get into a little bit of a different game. One of the things that we said over here is over in this area over here, these guys are holders, right? They're holding the contract, so they're holders. Now, these guys over here are writers. They're writing the contract. So a writer basically writes the contract, sells it to a holder who buys the contract. So the writer of a contract now has an obligation. They don't have a choice. They don't have rights like a long call or a long put. They've got obligations. Their obligations are forced upon them by the holders, okay? And a holder will force that obligation. They will force the writers to obligate themselves to the terms of that contract, should these guys get it right. So basically with a short call, I've got an obligation to sell. Remember over here, I got a right to buy. Well, if I got a right to buy, who am I buying it from? I'm buying it from the writer who's got to sell it to me. All right. So with the same analogy, if the stock is at 100, and let's say the call is at 95, so it's a 95 strike call, and the share price right here, $100 a share. Well, guess what? This guy over here is going to go, well, shoot, I own a 95 strike call. The stock is now at 100. I have the right to buy that stock at $95, and the stock is at 100. I'm going to buy it. So I'm going to come over here to this guy over here and say, sell it to me at $95 a share. Well, now this guy over here, he can't say, no, I don't want to. I'm going to wait. He's got an obligation to sell it to this guy over here. So when he sells it, guess what? He sells it at 95. This guy at 95 now has stock at 95, even though the current price is 100. He can then turn right around and sell it in the marketplace and make a quick $5. All right, he can make a quick $5. This guy over here, he's got to provide the stock, or he's got to essentially provide the stock. So he's going to provide the stock at 100, even though the stock's at 95. So he loses $5. Now, what happens 95% of the time? Most people are buying and selling the contracts, and they don't let these things get exercised and assigned. Sometimes they do, and sometimes there's certain strategies that you will employ where you want to get assigned a stock. You want to write a short, let's say a short put. You want to get assigned, but that's for another day. For now, just understand how these work. Now, the other side, of course, is the short put. And just like the short call, every time you're short, right, you've got obligations. So here we've got an obligation down here. But remember, over here, as a long call, you had a right, but you had a right to sell. Well, who are you going to sell it to? Guess what? You're going to put that stock to this guy over here. He's got to buy it, and he's obligated to buy it. He's got no choice. In fact, the brokerage firm will force it on him. It'll happen over the weekend. So he has no choice. So the expectation is bullish. So notice right over here, the expectation is bullish for a long call. Obviously over here for a short call, the expectation is bearish. Over here with a long put, the expectation is bearish, but with a short put, the expectation is bullish. So now we've got, notice here, I've got a bullish expectation here and a bullish expectation here. So now I can play a bullish expectation using long calls, or I can play a bullish expectation using short puts. Likewise, I can play a bearish expectation using short calls, or I can play a bearish expectation using long puts. So I think you guys can see that by trading a single leg strategy using a call or a put, long or short, you can play bullish or bearish. And then when you start to combine these into multiple legs, you can get fairly sophisticated in how you do it. The best way to start, though, is just to practice doing some of the basics. Now, if we were to come over and let's take a look at, I talked about the option pricing theory just a little bit here. There are a number of different pricing models out there. The Black-Scholes model is probably the one that kind of defined everything else. And these guys got a Nobel Prize for this. It's a mathematical model. So the pricing of options is based on a couple of different things. And we're going to go into that tomorrow night when we get into the Greeks. Okay? But for now, just understand there is a strong mathematical bias, and it's all about the math when you trade options. And most retail rat brain traders, beginning traders, don't realize that. And we'll go through some examples of how you can be bullish and still lose money if you don't know how to trade options. So options are based on two things, extrinsic and intrinsic value. All right. So if you think about it, let's use calls for a minute. And we'll just, the example here. So if you've got a 100 strike, a 95 strike, and then a 90 strike right here. And then we'll go 105 right here. All right. And let's say the stock price of this call right now, we'll keep it simple again for the math, is $100. So if a stock is at $100, a call strike of 100 is at the money, okay? It is at the money. And if you wanted to buy this call, this 100 strike call, it's not for free. It's going to cost you money. Let's say it costs you $2. Well, guess what? That entire $2 is going to expire worthless if somehow the price of this stock got frozen in time and then this option contract were to expire. There is no in-the-money component to this at all. So all of this is called extrinsic value. There is no value to this option contract at expiration. There is no value at all. So it is all extrinsic, all extrinsic. Now, if we take this strike price right here, and let's say the strike price of this thing at 100, the stock is at 100. So now let's say, well, I want to, let's come down here to 95. If I buy a 95 call, okay, now this means I've got an in-the-money component to it, okay? At a minimum, we know, and let's say this one costs me $7 to buy this one. If I spend $7 to buy this one, how much of it is in the money? $5 of it. So this one now has a $5 in the money plus $2 out of the money. And assuming time stands still, which it never does in the markets, but assuming it does, then this $2 goes away. And all I'm left with is $5. So I've got $5 to keep in this thing here. Okay, that is the trade on this one right here. If I'm out of the money, and let's say this is all out of the money right here, and let's say this one, just for math's sake, is $1, it's all extrinsic as well right here. So right here, I've got 100% of the cost of that option contract is extrinsic right here. I've got, on this one right here, I've got 100% of the cost of that option is extrinsic here. However, for this option right here, at that strike right there, I've now got right here, I've got $5 of it that's intrinsic. There is some value to that. Right now, I'm buying value. I'm buying value. And I've got $2 that's extrinsic. So, and as we get into more detail tomorrow, you will see why most traders that come from stocks into the option world tend to buy only bullish bets and only cheap options. And when you buy cheap options, notice this, I want you to look at this relationship right here because it's very important. If you look at this relationship right here, as we move further and further out of the money right here, what happens to this price of the option contract? It gets cheaper and cheaper and cheaper. Yet as we move deeper and deeper into the money, the option price gets more expensive. So when most beginning traders start trading, what do? They go, well, shoot, I want to go for this really cheap stuff. I can make some good money with this. It's only going to cost me $100, or it's only going to cost me $50 or $20 or $10. It's cheap. But you're going to see tomorrow when we get into the Greeks and how the Greeks really work and how these option models work, that's the very wrong thing you should do. You will see why tomorrow when we get into this, the 70 delta, don't worry about it now, but 70 delta to 80 delta is the ideal sweet spot for stock substitute trades, okay? And I'll explain that in more detail tomorrow. So intrinsic and extrinsic value, you need to know that on your stocks all the time. So this just walks through that example. Now we're going to go into more detail again tomorrow on the individual components that make up the price of an option contract. But suffice it to say that if an option, let's say you've got a 100 strike, all right, so that's the strike. We're going to buy a call, and let's say the stock price, okay, the stock price equals, we're going to call it 105. Well, no, I tell you what, let's call it, let's say it's 95. We're going to say it's 95. So the stock is at $95 a share, all right, and we're going to buy a, instead of a 90 strike, we're going to buy a 90 strike. So we're in the money by 5, all right? The stock's at 95. We're going to buy it at 90. So we know that we've got some intrinsic value in this thing and some extrinsic value in that thing. So right now we know that the intrinsic value is the easiest to calculate. It's a mathematical number. It's simple math, simple division. You can say the stock's at 95, the strike's at 90. So $5 of the total price of that option contract right now is in the money. It's intrinsic. The extrinsic, let's say right now just for practical purposes, is $3. So I had to pay a total of $8 for that option contract. Or if you multiply it by 100, $800 per contract is what that option contract will cost me to buy for every contract. Now, out of this $8, this $3 right here is the extrinsic piece. If you look at the extrinsic number, you will see here that the extrinsic number is made up of these things right here. What are the components of the extrinsic value? Most people understand time decay, but when you look at the terminology, they'll call it time premium. They'll generally say the time premium of this contract, all right, they say the word time premium. They'll say the time premium of this contract is $3 or $300 per $800. So they'll say one option contract costs you $800, and for every contract you're paying $300 in time premium. Well, that doesn't mean just the time decay that's measured by a Greek called theta, which we'll talk about tomorrow night. But it also includes volatility, and it also includes interest rates. And as you will see tomorrow, besides the underlying movement of a stock, volatility can affect the price of an option more than anything else. It can double or triple or quadruple the price of an option in one day. And in fact, it can move it sometimes more than the price of the movement of a stock. A stock may only move 30 cents in a day, but volatility jumps dramatically. And guess what happens to the option contract? If you're on the wrong side of the curve on that one, you're going to lose a lot of money for that day. So these are the components we're going to focus on tomorrow, and we'll kind of go through those. Now, one other thing I wanted to show you tonight is the option P&L graph. Everybody knows, well, not everybody, but you should know that a typical P&L graph for a long stock, right? What do? You buy to open. So I'm going to buy to open 1 share of stock, or let's say 100 shares. Whenever you start trading options and you start mirroring it with stock, everything's done in lots of 100. So everybody knows that if stock goes up $5, then it moves $5 on the quantity scale right here. It moves up, all right, from here to here. So let's say it moves $5. Well, then by the same token, you make $5 on the profit scale right here. It's very easy. For $1 of movement, for every $1 of movement, you make $1 in profits, up or down. It's very simple, very easy to understand. So that means that this graph right here, and I'm probably not drawing to scale, is a perfect angle, right? So that for every $1 move up, it moves up 1. For every $1 move down it moves down 1. So it's a perfectly angled thing. Same thing with a short stock right here. If I'm short stock, well, I'm going to sell to open, all right? So I'm going to sell to open 100 shares of stock. So I sell to open this thing right here. But so short stock, for every $1 down it moves, I gain $1 in profit. For every $1 up it moves, I lose $1 in losses. Again, it's that perfect angle that you're looking for there, 45-degree angles, what you're looking for. So it's kind of how you're looking at this thing. So now, if we come over here and we look at a long call, and what did we say a long call came with? Rights or obligations? That's right. It came with rights. So with a long call, you've got a right to buy. So I'm going to buy to open. It's a debit trade, meaning I got to pay to play with this thing. And notice right here, with every P&L graph, the bend in the curve represents the strike price. In this case, it's the strike price of 40. So I bought to open, let's just call it 140 strike call. 140 strike call, all right? So that's what I bought to open. My expectation is bullish. The distance here is the cost of that call. That's the most I can lose. And then obviously it starts moving up. I can start making money like this. So that is a long call. A short call, which is just the opposite, is rather than rights, I've got what? That's right, I've got obligations. I'm obligated to sell that thing. So my expectation is bearish. This thing here, this is how much I take in. Remember, as a short call, I am a writer of that call, which means I'm going to write it and I'm going to give it to who? The guy who's buying it, who is the holder. So as the writer, I write that contract and I put it out there. Someone's going to buy it. And when they buy it from me, this amount right here is the money that I'm going to make. Notice this is all I can make. I can't make any more than this. I'm flatlined. But then if this thing starts going up, if the stock starts going up in value, I can lose a lot of money here, a lot of money, because stocks can go up to infinity. So there's unlimited losses to the downside here, but there's limited gains. It's a credit trade, so I get paid to play here. My expectation is bearish. Long put, Well, again, I'm long, so that must mean I got what? I got rights, right? I got rights here. So these are my rights. I got a right to sell because it's a put. I'm going to put it to them. I'm going to put that stock to you. So I've got a right. My expectation is bearish. Notice this thing can go here. In theory, stock can only go down to zero. So my profits are limited to the stock going down to zero. Once it goes down to zero, I can't make any more profits. But my losses are capped right here. The bend in the curve represents the strike price. It looks like in this case, let's call it 58. So the strike price is the bend in the curve right here. I can't lose any more than this. This is the cost it costs me to go out and buy that put. So again, I'm buying to open right here that long put contract. And I am not a writer, but I'm a holder. And then I'm selling a put. In this case, I've got obligations, right? As a short guy, I'm a writer. So I'm writing a contract, and I'm going to go out there and try and sell this contract. So when I sell that contract and I sell it to you across the table, I've got to obligate myself to that contract because I'm the one that wrote it. I've got an obligation to buy it back. So I'm selling to open that contract, selling to open. My expectation for a short put is bullish, right? Same thing with a long call. So we can use a long call or a short put to play a bullish play. But with a short put, notice my profits are capped. When I write this contract, I collect a premium. The premium is this distance right here. That's the most I can make. I can't make any more than that. What can I lose? Well, a stock can't go down below zero, but I can lose a lot of money if it starts going against me. It's a credit trade, so I get paid to play. So those are the basic positions across stocks, and these are the basic positions with stocks, puts, and calls. Now what we're going to do tomorrow night is we're going to go into the Greeks. We're going to take a look at them. We're going to lay them out, and then we're going to come back through these again, and then we're going to apply the Greeks to some option chains, and then we're going to do some common long calls, short calls, long puts, short puts, and we're going to just look at some of these things and some of the gotchas that a lot of traders, rat brain traders, beginning traders really make mistakes with as it relates to volatility and what you need to look at when you do this. This session will be posted for our members in our forum. For those that are on tonight's session that are non-members, we will send you a direct link where you can go look at this anytime. Same with part 2. The webinar invite for part 2 will be coming out tomorrow, and it'll be the same password as tonight. So hopefully you guys enjoyed this free session. A lot of stuff to talk about here. Hopefully we'll get it covered, more of it tomorrow. So have a really good